During our stock analysis, we are going to explore the key pillars, examine the ownership, look back at past results. We will find out what the analyst predictions are, as well as give the business a valuation, and examine the potential return on our investment. And finally, we will summarize our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests these are the key metrics when first evaluating a business. The first pillar we are going to explore is earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. For Stellantis, this is terrible for the trailing 12 months, and they're down by -27%. Now, let's look at the free cash flow, which is the money a business can generate from its operations. And here we can see Stellantis has not been able to increase this, as their free cash flow is down by a massive -70%. Then we come to the next pillar, which is revenue. And this tells us how good the company is at generating income before deducting expenses. Stellantis' revenue has decreased by -5% in the trailing 12 months. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. As for the last 12 months, Stellantis' book value is up by just 2%. Ideally, we would like to see the growth for each of these metrics increase by 10%, so this begins to reveal why their share price is currently at their 52-week low. But we need to ask ourselves, can they recover? Anyway, let's now turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are superb at 12% and 16%. Now we move on to debt. And Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. So, using their current free cash flow, it would take them about 8 years to pay off the debt, which for me is a bit of a concern. In this next section, we now focus on other key metrics which help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently 18%, and this is a little low, as we would like to see the gross margin over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on a dollar of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Their operating profit margin is reasonable at 10%, but is below the ideal 14% we would like. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 7.65% this looks excellent. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is 8%, with the lowest point being last year at -1%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 104%. The book value growth is a little lower than the ideal 10%, but an earnings growth looks incredible. However, this number is massively inflated due to the net income increase in 2020 to 2021, when the growth was 553%. If we look at the last 4 years, the earnings growth is 0%, so there has been no actual growth, which worries me as a potential investor. In the comments section, I've included a link to the investors page in the annual report, if you want to check it out for yourself. This is Bitesize Investments, giving you a step-by-step approach on your investment journey. There are currently 6 super investors who own this company, and between them they invested $32.4 million in Stellantis in Q1 of 2024. If we look back at Paul Tudor Jones's previous sales and purchases, we can see he has both bought and sold shares in Stellantis in the past few years, and has added more shares to his portfolio in Q1 of 2024. He has a very small position invested in Stellantis, which doesn't even register in his portfolio. Nevertheless, he has about $249,000 invested in the company. None of the 6 super investors have a big holding in Stellantis. The highest being held by Jeremy Grantham, who has $124 million invested, but this is only 0.45% of his overall portfolio. However, 2 other super investors have sold shares, totaling $19.4 million in Q1 of 2024. Ben Miller has previously bought into Stellantis, but in the last quarter he sold 66,000 shares. He sold 13.3% of his holding, but still has $7.59 million remaining in the company, which makes up 4.8% of his overall portfolio. Now we are going to look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. We can see that Stellantis have been on a bit of a bumpy ride. They seem to go on a successful run for 3 years, and then have a dip and go on another run. At present, following this pattern, they look like they could be due another dip in 2024. On average, the analysts believe that the price target should be about $30, but some believe it can go as high as $39. Analyst reports suggest that Stellantis is undervalued at the moment, and the overall consensus is they are a buy. Collectively, the analysts believe the company won't continue to grow, and will possibly shrink in value by up to 27%. However, they also believe they could grow by 3% over the next few years. I will use the current earnings per share of 4.34 as my starting point when creating a valuation. Based on a combination of the past growth, future analyst predictions, and the average book value for the past 10 years, I am going to estimate the earnings per share growth to be 6%. Then, I am going to give Stellantis an estimated PE ratio of 10. After that, I will project these numbers forward by 10 years. We then need to include a 15% return from our investment. This then gives me an estimated future stock price of about $78 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $19. Then we apply a margin of safety. At 25% it gives me a buy price of about $14. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. If you found this video useful, please consider giving it a like, or click on the link above to check out my last stock analysis, or continue to watch as we are going to look at the possible return, and compare the bull and bear cases. The return we would receive, if we bought at our 25% margin of safety price of $14, and sold in 10 years' time at our estimated future stock price of $78, would be 457%. But, this is dependent on our assumptions for the company being correct. Surprisingly, Stellantis provide a dividend, which is $1.55 at the moment. The dividend growth is 8.78%, and the payout ratio is 35%, which is within our acceptable parameters of between 20 and 50%. Let's find out more about the company and its competition. According to Morningstar, Stellantis don't have an economic moat. According to the discounted cash flow analysis, Stellantis could be undervalued. One model suggests a fair value is around $83 per share, while another, using net income, indicates a fair value of about $130. In addition, 6 out of 8 analysts have a buy or strong buy rating on Stellantis. Over the past 3 years, the company has delivered total return of 43%, which places it in the top 10% of its industry. Now let's look at the bear case. Year to date, the total return has been negative, placing Stellantis in the bottom 25% of its industry. Recent net income growth has been lower than its 3-year average, which could raise concerns. And lastly, total debt has increased by 8.51% over the past year, which may raise questions about their financial health. If you have enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Stellantis scored 4.5 out of 12. Under ownership, 6 super investors have bought in the last few quarters, and 2 have sold shares. However, none of the investments constitute as major holdings within their portfolios. Their average share price is in an upward trend, but based on past performance and poor financial results, they could well see a dip. And analysts are indicating Stellantis is a buy, and they are predicting they will shrink between -27% and possibly grow by 3% in the next few years. Using the EPS growth model, my personal buy price would be $14 or less. However, this company isn't within my circle of competence, and is not one I would feel comfortable buying. If you click on the link above, you can find out about my personal portfolio. According to Morningstar, Stellantis don't have a moat, and my final overall rating is 3 out of 6 stars, and I have given this a category C rating within my own stock watch list. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating.